Now, the important question comes is, what leads to such an opportunity, and how do you discover such an opportunity of buying a company at an early stage?
So hello everyone. Now we are moving on to the next session. My name is Vikas Agrawal and I'm the founder of AIF and PMS Express India. We are emerging as one of the largest platform for investing in alternate investment funds and portfolio management services. At AIF and PMS Express India, we keep organizing these knowledge-based sessions, and the whole idea is to educate and empower the investor community as a whole. And with me, I have Mr. Himanshu Upadhyay, he's a portfolio manager. He's a vice president and portfolio manager public market. What we thought is idea is to invite him and understand, how does he invest, what kind of investment philosophy do they follow at BugleRock, which is also formerly known as O3 Securities. So Himanshu comes with 15 years of experience. He's IM, MBA from IM Kozhikode, brings about 15 plus years of rich experience on the buy side in Max Insurance, M3 Investment, and PGIM, which is Pramerica, the Indian Mutual Fund unit. And he follows the absolutely bottom-up approach with a very strong research process and intention of holding on to chosen businesses for long period of time. So he's not someone who would buy for a short period of time. Prior to O3 Asset Management, he has worked with PGIM that we've already informed you, and he holds a degree in MBA. So from IM Kozhikode. So over to you, Himanshu. If you wish to share any presentation, please feel free.
Yeah, I have uploaded the presentation. I think the moderator will.
Yeah, just okay.
Yeah, 1 minute.
Yeah. Over to you.
Yeah, is it visible to you?
Yeah, you can move the slides also. I can see that. Yeah. You are moving the slides, right?
Yeah.
Okay.
So, hi, good afternoon. And thanks for giving us an opportunity to share our thoughts on early stage investing, and which is what we do. Now, what is early stage investing? Okay. And how do we define it? So what we are trying to do here is invest in companies where the business prospects have improved quite materially. Okay. But not yet reflected in the financials of the company, and the operating parameters have improved. The financials means the profit and loss, balance sheet, cash flows, and the operating parameters can be the order book. Those parameters have improved. Secondly, what we are trying to do is buy in companies where the improvement in business prospects should lead to substantial increase in the profits, cash flows, and the net worth of a company. If we want to buy and hold a company for a very long period of time, and that is what Vikas also stated, the whole thought process is that you should buy a company where the improvement in prospects will not be only for 1 or 2 years, but for a number of years. And this company can transition from small to mid cap space or mid to large cap over a longer period of time. Now, the important question comes, why should a person invest at an early stage? Okay. So the reason to invest at an early stage is it gives you an opportunity to buy with high margin of safety, and which is very, very important for us as a long-term investors. As earnings grows, what we also have seen is the valuation multiples will also improve, and which helps in generating high returns over a period of time. The third important thing is the strategy is different from various other strategies in the market, which leads to low overlap with the other strategies, and the Nifty 250 is small cap index, which is a very wide and diversified small cap index. Historically, the portfolio has had overlap of less than 10% with Nifty small cap 250 and other strategies in the market. The other important point is, if you are able to buy a company at an early stage of its recovery, you will be able to sit with the company for a pretty long period of time, which will lead to lower churn in the portfolio. And as the churns will be low, the taxation will also be lower for the clients. Okay. We have seen certain companies in our portfolio have moved from 1,000 crore, 2,000 crore to become today 20,000 and 25,000 crore market cap companies in a period of last 2 to 2.5 years. Again, if one data point which I'd like to share with you all is, following this process has helped us in building a portfolio which is at a low price to earning ratio, has a decent EPS growth rate, and the final impact is lower PEG ratio in comparison to small cap index and even BSE 500 TRI, which is the benchmark for us. So this gives you a high margin of safety with higher growth potential and a high probability of making decent returns. Why is the portfolio focused only on mid and small cap space? The reason for that is, the companies in small and mid cap space are focused on few lines of businesses, and even a small improvement can lead to significant improvement in their profit and loss, cash flows, and the net worth of a company. The second important point is, the universe of small and mid cap companies is pretty large, and a lot of those companies are not so well tracked, leading to certain companies remaining unnoticed in the market, even when the business prospects for them have improved quite significantly. So those are the two reasons because of which we have chosen to focus our energies on mid and small cap space. Okay. Now the important question comes is, what leads to such an opportunity, and how do you discover such an opportunity of buying a company at an early stage? The important thing to look out for is there something changing in the company's external atmosphere or in the internal working of a company? The external change can be something like change of regulations. I'll just give an example of it. So what we saw in China, in chemical companies or chemical manufacturers, the regulations of pollution control became very, very tight. It led to many Indian companies, especially on the chemical companies, becoming more and more cost competitive with the Chinese companies, and they became much larger in comparison to what they were 10 years back. And it led to many small Indian companies becoming global companies in that particular line of their business. Another example, if I take on it, is what we are seeing in terms of change of regulations is new education policy. We are continuously hearing in newspapers and magazines that the government is focused on implementing new education policy. It will lead to change in syllabus and new subjects will get added. Now, this change will impact a lot of publishing companies, and what we are going to see is consolidation in the publishing business, or books in the consolidation in the book publishing business, especially for schools. And the second thing what we are going to see is that second-hand books, which is a very large market, will become redundant as the subjects and the syllabus changes. The older books will not be of much help. Hence, the larger players will gain market share, and the second-hand books will becoming redundant. For them, new revenues or the incremental revenue will be much higher. Currently, we are playing such a theme through Navneet. Another example we can take of an internal change. And internal change can be because of change in the promoters, because of merger or acquisition, company going into an NCLT, next generation taking over. We played such a situation in Orchid Pharma, where the company went into NCLT and Dhanuka Group bought it over. Having looked at the Dhanuka Group and tracked them for a very long period of time, we had a very high confidence in their ability to turn around the company. The other reason which gave us confidence in their abilities was they were into a cephalosporin or a similar line of business in unregulated markets. So it was not something that the new people who were going to take over Orchid Pharma had no experience in that particular business. They were experienced business, had a clean track record, and had run the businesses much more cost efficient than other peers in the particular businesses. Hence, we chose this particular company because of turnaround, because of change in the promoters, what we were seeing. Another example I'll just take, but I'll just make an important point. Differentiating between a strong and a weak company is much more easier in the bad markets than in a bull market. Okay. When every company in a bull market is doing pretty well, bull market here means bull market for an industry. If the businesses are booming, looking for very good players is much more tougher than in a bad period. And if in a bad period you are able to choose a good company, then what you need to do is you need to buy it at a cheap valuation and wait patiently for the cycle to recover or the fortunes of the industry to change. One example of such a scenario we played was in real estate, where we saw that a lot of competitors were weak, were leaving the industry, and were in a distressed situations because of demonetization, GST, RERA, NBFC crisis, leading to lack of funding availability for such players. And the final nail in the coffin for these players was COVID. And what we were seeing was because these weaker players were moving out, the consolidation in the industry was happening, and few players were continuously gaining market share and growing despite the market not growing. So that was an important point what we felt. Now, when we meet a company or an analyst, everybody will have a belief that their fortunes are going to improve. And as human being, we all are always optimists. So we always will feel that these things are going to turn around. But how do you differentiate between what you are going to invest or how is the fortunes really improving? The way we'll do it is by looking at the operating parameters of a particular company. If the operating parameters or relevant operating parameters of a company are improving, we can be more confident that a real change is happening in the company and which will lead to increase in the profits, cash flows, and the net worth of the company. An example of operating parameter is increasing order book. If we take for most manufacturing companies, generally the first thing will happen is the order book will increase, and over a period of time, that increased order book will mean the revenues will increase. And once the revenues increases, we'll also see economies of scale will happen. And because of economies of scale, the margins will also tend to improve. So this is one of the examples of looking at operating parameter in a manufacturing company. Another example for a manufacturing company, from a manufacturing company's perspective, is increasing proportion of spares services business, which we can also term it as aftermarkets business. For almost all companies we have tracked or looked at, the aftermarkets business is more profitable than sales directly through an OEM manufacturer. So generally, we will like to focus on companies where we are seeing that just just not the revenues are increasing, but also the aftermarkets business is increasing. The third example we can take is, let's say, a real estate sector. Okay, in case of real estate sector, the uniqueness is the revenue recognition happens only once the completion of project has happened and you are delivering the keys to the end customer. Till that time, you are not going to recognize the revenue. This is the accounting standard. Now, how do you understand that? Is the company doing well? Is the fortunes for the company increasing? And that happens, or the way we do it is by looking at the new sales which are happening for the company. What are the quarterly collections they are making from the customers? What construction spend they are doing? Are they increasing or reducing debt on the balance sheet? So these are some of the operating parameters which help us in knowing about how the real estate company is doing, and is the fortune for that particular company changing for betterment or not. Another example we can take is for a pharma company. For a pharma company, there can be change in the sales mix. Okay, and change in the sales mix can lead to substantial change in the profitability of a company. So let's say for a pharma company which is into injectables and oral dosages, the injectables business is generally more profitable than oral medicines. Okay, and if we are seeing that the business of injectables is increasing at a pretty fast pace, the profitability of the company will also improve over a period of time. The other important thing, what we can also see in terms of pharma company for change of sales mixes, is the medicines for chronic uh, diseases, or the proportion of revenue from medicines from chronic diseases like blood pressure, thyroid, diabetes, increasing versus acute diseases like fever, pain, etc. Because once a person starts medicines for blood pressure or thyroid or diabetes, he will continue to take those medicines for a very long period of time. And hence, it's much more of a repeat business for a company. That's why, again, looking at how the sales mix is changing can be helpful for us to understand the profitability and the growth in revenues for a particular pharma company. So these are 4 5 examples of I took for change in operating parameters which have helped us in buying companies at an early stage of recovery. I'll take one theme in much more detail to describe how do we look at the macro level change and how it flows to operating level changes for a particular industry or companies where we have played. One of the interesting themes what we found was there is electricity growth with disruption. What we were seeing 2 years back was the penetration of white goods was increasing. The penetration of automation in homes, at the factories, was also increasing. Electrification of vehicles and railways was happening. Data centers, or the penetration of data centers, was going to happen. And all this thing would have led to increased demand for electricity. But the disruption what we were going to see, or we were expecting to see, was majority of capex or new energy requirement would be met through renewables energy. Historically, majority of capex would always happen on coal-based power plant or a nuclear-based power plant. Now, what type of change would it have led to? So historically, what we used to see was there used to be a centralized coal-based power plant or a nuclear power plant. The coal-based power plant would be near the coal mines or near the seashore and where ample quantity of water is there. And this centralized power plant would supply power to your houses, factories, commercial buildings, all those places. But renewable sources of power are not 24 by 7 sources of power. And so you will require both solar-based power plants, you will also require wind-based power plants, waste-to-heat power plants, gas-based small power plants. So the sources of power would be a multiple. The second important thing would be that this is far more distributed generation of power, which will lead to far more capex on the transmission and distribution setup. And companies which are into the transmission and distribution business will tend to benefit out of it. What we ultimately were expecting was that companies which will benefit from the increased demand are going to be much different than historically the companies which grew. So most of the companies which manufacture boiler, turbine, generators for a solar based or a wind turbine or waste to heat are smaller companies. Okay. And companies like BHEL and all these are not present in that portion of the market. And we had few very strong companies in that boiler turbine generator space for lower than 200 megawatts. And hence we bought Thermex on the boilers side, Triveni, which is world's second largest turbine manufacturer for less than 100 megawatts for turbines. TD Power is a manufacturer of generators and has a pretty high market share for their global generators below 100 megawatts. So those were the companies which we were expecting, or we are still expecting to do pretty well based on the capex which is happening in the electricity sector. Two more companies which we have chosen in this particular sector are APAR Industries and Savita Oil Technologies. APAR Industries is into the conductors space, transformer oils, and wires for the renewable energy space. Now, globally, they are among the top 3 in conductors and even in the transformer oils space. Okay. So, being a top 3 in both these segments, we expected the growth of renewables should lead to a very high growth rate for that particular company, not just in India, but outside India also. Savita Oil has a larger proportion of business in India, but the type of demand we are going to see in transformer oils, even their business will likely to expand at a very high rate. In last financial year, both of these companies have seen double-digit volume growth rate in the transformer oils businesses. Some of the other themes what we are playing in this particular space, or I would say early stages of recovery, are companies which are still, and I'll narrate some of the examples also so that more clarity is there. Small giants are the companies we call or we term as companies which are small in market cap but have a large market share in the relevant business they are doing. An example of that is Menon Bearings. Menon Bearing is a company which is into the engine bearings for commercial vehicles and tractors. The margins for this company are pretty high than other engine bearing companies in the market. The reason for that is that they have chosen to be in a niche segment and work with global players like John Deere, Cummins type of companies and have a higher share of their business. They don't have any presence in passenger vehicles. The focus for that management is to have high market share. in CVs and tractors, as the profitability is much higher for them. So even as despite being a small company, even in a year like COVID, they were able to get more than 20% EBITDA margins because of high market share in the businesses where they were present. Another example of a small giant is Suprajit Engineering, which is small company in auto ancillary space, but a dominant company in cables business in India and outside India also. And it has continuously focused on expanding its footprint geographically and also the product profile over a period of time. One more on real estate sector, what we were seeing because of change in the regulations, customer behavior, the consolidation was likely to happen in that particular sector, and hence we chose residential real estate sector for investing. Okay. Now, what we have seen historically is the markets where the job creation has been pretty good. Those are the markets where the demand for residential units is also pretty high. So we saw that historically Bangalore, Pune, NCR markets have done pretty high job creation, and hence we chose three companies from these markets. In case of Bangalore, we chose Shobha. From Pune, we chose Kolte Patil, and in case of NCR market, we chose was a company like Ashiana Housing, which is also into senior living category. And we believe that as the country progresses and becomes richer, senior living as a category can become pretty large over a period of time. I'll take one more case here. Revival in tourism, travel and tourism, okay, post-COVID. So we have few companies in this space. One is Sinclair's, Taj GVK and Acelia Solutions, okay. Sinclair's Hotels has most of its properties in the Northeast market, and Northeast is yet an unexplored market, and the transport infrastructure is still improving. We believe as the transport infrastructure improves over a period of time, more and more people will travel to that side of the country also, and the growth in hotel industry in Northeast will be pretty high. We have seen such a scenario happening in Leh and Ladakh, where 15 years back, very few people would go and visit. Now we are seeing a number of people or the increased tourism activity in those markets as transport infrastructure has improved in those areas. Taj GVK again was an interesting story we felt because of its presence in Hyderabad market. In the Hyderabad market, and one second. In Hyderabad market, as the sources of businesses are much higher in that particular market. So you have various industries in that market. You have agrochemicals, chemicals, pharma industry, IT industry, and hence we felt that that market will do pretty well post-COVID. Okay. Now, I'll take 2-3 more minutes on portfolio construction. We have a pretty concentrated portfolio of 15 to 20 stocks. Maximum weightage in a particular sector is 35%. Maximum weightage in a particular stock at a current valuation or at the point of purchase would be around 10%. And one thing which is currently challenged for us is it is taking more period time for us to invest in a particular portfolio for a client. So historically, we have aimed to get around 80% invested in a particular portfolio for a client in 8 to 10 weeks, which is taking more than 10 weeks currently. So this is a point which should remember. See, one more important, the last slide from our side is how do we manage risk in small cap space? So the chief risk for an investor is making an error in our assessment of a company. We try to reduce the risk by investing in companies which have a listed history of more than 10 years. And why 10 years? Because it gives a better understanding of how the management has behaved and allocated capital historically. Again, another issue what we have seen historically is companies which have high debt on the balance sheet and have poor credit rating have failed to survive in tough period, and hence we want companies which have high credit rating and low debt to equity. The third and final important point is we want promoters and our interests to be aligned. So we want promoters' stake to be high in the company, and they should not have most of their shares pledged. So that is one of the important criteria to ensure that promoters' interest and our interest is aligned. I'll take the final slide on product update and how the portfolio is. So if you look at it, the portfolio credit rating is pretty strong. The median credit rating is AA negative. It's a the portfolio has a diversified sectors. It is not concentrated into any particular sector, and the average promoter stake in the portfolio companies is around 60%. And the returns in last since inception, as of 31st May, have been 55%, and in last 1 year 60%. Yeah, I'll end it
Yeah.
here.
Okay.
Vika.
Thank you, Himanshu. Particularly, what I like is your rating process. So on the one hand, you rate the company's basis various parameters, the in-house parameters, and then at the same time, you also track those parameters, and based on that, you change the asset allocation. So very nicely done. In fact, congratulations for delivering the extraordinary returns ever since the portfolio has started. And we look forward for more sessions like this from you. It was a great presentation, Himanshu.
Thanks, Vikas. Hope to be of hope it has provided value to other
Oh yes,
clients,
absolutely,
and
absolutely.
we also enjoyed having a session with you.
Yes. There were a lot of
Thank
requests, in fact, and all of them wanted to know more about this special situation. They wanted to know about small cap investing. So we thought who would be the better than you to kind of discuss about it. You've been successfully generating alpha in the portfolio. So thank you so much for, on behalf of our investor, I take this opportunity to thank you.
Thanks. Thanks.